What's up, well builders? Ryan Pineda here. Today we are going over how to invest in real estate in 2025, all the way from being a beginner to being a seasoned pro. And I'm actually going to give you 7 predictions that I think are going to happen as we go into 2025 and how you can best capitalize on them. Prediction number 1 is that rates are going to drop. Now, this is obvious. I think everybody agrees rates are going to drop. The question is just, how much are they going to drop? And if that happens, then what else happens as a byproduct? Well, I'll tell you this. I think we can all probably guess rates are going to be somewhere between 5 and 6%. At the time of this video, we're still in the 6% plus range. And so I think by next year, clearly we'll be anywhere from 5 to 6%. That's probably like with 100% certainty. The question is, do we get near towards 5, maybe even into the 4% ranges? And I think that that's very likely. I would guess that probably the average next year at some point is going to be at about 5% flat. I don't see it going into 3% range or anything like that, but I wouldn't be surprised if it got under 5%. Now, that being said, what does that mean for the real estate market? Well, historically, anytime rates drop, that means that prices go up. Now, you could see this correlation if you just look at real estate throughout history, but the reason being, if you don't know, is that when rates drop, your ability to spend more goes up. Right now, if I had a $500,000 house I was looking at with a 6.5% rate, well, at 5%, I could probably afford a $600,000 house with the same exact mortgage. The math isn't going to be the exact same, but you kind of get the point. So if that happens, then what are the side effects? Well, typically when interest rates go down, prices go up. And the reason this happens is because people's buying power just increases. Take, for example, say I'm going to go buy a $500,000 house and I'm going to get a mid 6% interest rate. Well, in that scenario, my mortgage might be around $3,000. But if rates go down to 5%, they drop 1.5%, I would be able to afford almost a $600,000 home with the same exact payment. I'll be right around $3,000. So at the end of the day, interest rate matters because that's how buyers of normal single-family homes look at it. They're like, yeah, what's my monthly payment? How much can I afford? Typically, when they go to get a loan, they have debt-to-income ratio limits, and most people go all the way to the top of their limit. And so if they can afford $3,000 a month, they're going to buy the best house they can for whatever they can afford at $3,000 a month. And so if that's a $600,000 home, it's going to be a $600,000 home at that interest rate. If it's $500,000 at this interest rate, then it's going to be $500,000. The thing is, the prices are going to go up because people are going to start bidding up these other properties because now all of a sudden everything just got way more affordable. And so if that happens, then what happens to everything else? Well, I think that causes a few domino effects. The first being that more supply is actually going to now hit the market. We've had very low supply the last few years, even with higher rates, because all of these people were locked in on their mortgages. Like many people have 3% rates and below. And so they're like, dude, I don't want to sell. Rates are 7% right now. I'm never going to see 3% again. And so most people had no chance or opportunity to sell. If rates get down to 5% or even dip below 5%, you're going to see a lot of those people come off the sidelines because even though their rates are 3%, they're now willing to go move into something else where they can go get a 4.5% or a 5% interest rate. And so even though it's going to create way more buyer demand, we're also going to see more people selling with this because there are going to be people who have lots of equity, even though they have a low interest rate, because all these buyers are bidding up the properties, things are going up. These people are going to have equity and say, hey, you know what? I want to sell, tap into my equity. I'll go buy something else now because rates aren't so bad anymore. Even though prices have gone up, basically it's going to end up being a net wash for them, but it's just going to cause more transaction volume to happen. More people are going to want to buy, more people will be willing to sell as prices go up and as rates start to come down. I also think that this is a great opportunity for anyone who wants to buy right now at the time of this video because that actually hasn't happened yet. And so if you buy a property at today's values, at today's interest rates, you now have the ability to buy now and refinance later. I think the realtors were coining it a while back of marry the home and date the rate. And it's true. It's like at the end of the day, if you buy the home that you want, whether it's a primary or a rental, this rate is temporary. It is going to come down. And so if you can go refinance it 6 months from now, a year from now, and all of a sudden lower your monthly payment by hundreds of dollars, Well, all of a sudden a property that maybe wasn't cash flowing can now cash flow pretty significantly with the right interest rate. And so I think that you're going to see a lot of people start to do that. In fact, I'm already seeing it in our business. We've wholesaled a lot of homes that people are keeping as rental properties. And my assumption is they are not cash flowing today at what we're selling it to them for. Like, I already know that for a fact. But my assumption is they're planning on refinancing in a year because they're pretty savvy investors. They're not dumb. So they're not buying it for no reason. And overall, I think it's just going to create a much more positive environment for investing. You know, for a guy like me who does coaching, you know, lots more people are going to want to learn about real estate investing. So, you know, we're happy to teach you, you know, the link's in the description, but also too, it's going to lead to more people wanting to put their money in real estate, more people investing in funds, more people investing in their own properties and buying houses. And, you know, it's just going to be good for the whole real estate market in general. Prediction number 2, flipping and wholesaling is going to get easier in 2025. Now you might be thinking, Ryan, I mean, if there's more demand and more interest, wouldn't it be harder because there's more competition? No. If you've been in flipping and wholesaling the last 2 years, then you know that it has been much harder in a bad market, right? I mean, number one, when they doubled interest rates back in 2022, if you were sitting on a bunch of properties like I was, odds are you probably lost money. And that's exactly what happened to me. I lost a bunch of money, paid back all my investors, but I personally lost a lot of money when the market shifted. And guess what? When you're flipping and you're wholesaling, you need to sell the property to somebody. So when you're in a bad market and nobody wants to buy, sure, it's easier to, like, you know, get people to sell you their homes, but it's very difficult to exit the property. You know, it's not impossible. Clearly, we've done lots of deals the last 2 years, but it gets harder to exit. It's just far easier for me. Like, I've been in very good markets, you know, COVID from 2020 to mid 2022. Selling the properties was the easiest thing on earth. Like, anybody with half a brain could make money in real estate, right? The last 2 years, you had to really refine your skills in order to make money because exiting the property has been the more difficult part. Well, once things get easier, more people want to buy, rates are better, exiting the properties becomes easier again, prices go up, so you don't have to worry about having your numbers be perfect or, you know, maybe being in a down market. You know, you have more room for error essentially. And so flipping and wholesaling gets a lot easier in better markets. And I know that, like, a lot of people think like, oh, the bad markets are where you make your money. I don't know. That hasn't been my experience, especially when you're flipping and wholesaling. And it's not the experience that I think most people had the last 2 years. I think that a bad recession can make you a lot of money back in 2008, 2009, 2010, if you bought long-term properties to hold. But, you know, flipping in those times was also hard because there wasn't, once again, a lot of buyer demand. But, you know, long-term hold, it was great. And I would just argue that long-term hold's great no matter what, period. So it doesn't matter what time it is. It's always great to hold if you have a long enough time horizon. But my point with all this is, you know, at the end of the day, a better market is good for flipping and wholesaling. More buyer demand helps, more appreciation helps, and also too, more sellers willing to sell and leave their 3% mortgages help. It also opens up the opportunity to take some of these properties subject to. Let's get into prediction number 3. This one's for the more hardcore direct to seller, you know, house flippers and wholesalers. But that is, I believe cost per lead is going to keep going up. Now, to give some background for those who don't know who I am, I have bought and sold over $100 million worth of house flips, okay? Along the way, in order to get all those deals, I have spent millions of dollars on direct-to-seller marketing. I have done TV commercials, spent millions. I've done pay-per-click. I've done direct mail, cold calling, text messaging, everything you can imagine. I have done it all, right? Today, currently, our main marketing source is Facebook ads. And the reason I went to Facebook ads is because they are inbound leads that are highly motivated, but they are far cheaper than all the other lead sources for inbound marketing. To give context, when I first started doing TV commercials back in 2020, you know, my cost per lead was anywhere from, call it $200 to $300. And then as we fast forward to 2023, 2024, you know, it had basically doubled. You know, they were anywhere from $500 to $600 on the high end. PPC is no different. You know, when I first got started doing PPC, this was probably back in like 2020 again. You know, we might have saw PPC leads for $300 here in Vegas. Now they're all the way up to like $800. And so, you know, long story short, cost per lead has been going up. The same thing is true even with other marketing sources, whether it's direct mail, whether it's text messaging, cold calling, all that stuff. You know, Facebook right now, we pay about $200 a lead here in Las Vegas, which is far less than the other ones I mentioned. And so it becomes like the cheapest inbound lead source, and that's why we're all in on it. But even Facebook, probably, I wasn't running it for direct to seller 4 years ago, but I would guess, man, the leads were probably $50. So long story short, I see this trend continuing here in 2025. I actually think that all the normal sources that people do are going to keep going up. I think that PPC is going to go up. That's the most popular inbound lead source. It's the easiest to start running. There's the most companies. I think that that's going to go up tremendously. I think that direct mail keeps going up. Cold calling and text messaging continues to have more headwind against it because number one, more people are doing it. Number two, there's more regulations. So when there's more saturation and more regulations, it can't help but get more expensive. And that just is the way it is. And it doesn't mean you can't make money doing them. You can make money doing all the things I just mentioned. But my point is cost per lead is going to keep going up. And so if we know that lead cost is going up, that means you got to do one of two things in order to make the profit you want to make. Number one, you got to increase your wholesale fees or your flip profits, because if it costs me more to get a deal, I better make sure that I have more profit to cover that cost. So assuming this happens, there's only 3 ways to remain profitable as a house flipper and a wholesaler who's doing direct to seller marketing. Number one, you just raise your fees. So somehow you make more per your wholesales, more per your house flips, all that stuff. That would help you maintain your margin. The second is you just get better at conversions. And so, instead of 1 out of 20 contracts closing, you need 1 out of 15, right? That helps you offset the cost because now you're just closing more of what current leads you have, right? Or the third is you better find alternative sources to marketing that are more undervalued that are going to get you better ROI. For me, I took the approach of all 3, so we got better at wholesaling and dispo by doing things like novations, where we're listing them on the market and getting retail buyers. So that has increased our overall wholesale and assignment fee. Number 2, we've become more efficient with the sales process. We're actually locking up the majority of our deals over the phone now at higher rates. And then number 3, I ended up transitioning to Facebook ads for the majority of my marketing budget, which are significantly less than all the other sources I've been using. So my team's getting way more inbound leads now and way more at bats, and we're making more money. And we actually do that for other people now through my company called Lead Kitchen, where we'll literally run my ads in your market and you get the leads. And so it's a really cool thing. You can learn more about it by clicking below. But long story short, cost per lead is going to go up in 2025. I'm 100% certain of it. And marketing is just going to keep going up in general in all of business. It's not just a real estate thing. It is a business thing. So unless you could figure out how to do one of those 3 things, then, you're not going to be in business very long because your margins are going to get cut too thin. Prediction number 4, properties are going to cash flow again. Now I can already see it in the comments. Ryan, properties have always cash flowed, dude. You're just not buying in the right markets. You got to come to, the Midwest. I don't even know why I'm talking like that now. But that's how I imagine everybody who says this in the comments. And look, you're right. There are properties that have always cash flowed to this point. But, here's the thing. It doesn't cash flow in most markets, especially good, let's call it tier 1 markets like a Vegas, Southern California. It just is very difficult to find cash flow properties, especially if you're trying to burr, right? If I'm trying to go get properties all in at 80% of value and do a refinance, they just have not cash flowed in great markets. Now, the beauty is things are going to start cash flowing again once we have these lower rates. And if you start buying some properties today, at the end of the day, once again, if you buy a property today, you refinance it in 6 to 12 months, odds are you're going to get today's pricing before appreciation happens, and you're going to get the lower rate. And so things should cash flow even in great markets. And so I'm really excited for that right now because, cash flow has been tough to come by the last couple of years in all forms of real estate. And, for me, I haven't been focused on rental properties the last year and a half, mainly because every deal I look at, let's say in here in Las Vegas, because that's the majority of our deals, our option is, we can wholesale it and make 40 grand. We could flip it and make, let's say 50 or 60. And you might be saying, well, Ryan, that doesn't make sense. It's true. Our wholesale and our dispo have gotten so good with novations and wholesales that it's almost the exact same profit as what we would do if we flip. And in a lot of cases too, with novations, we make more than we would have flipping it because we couldn't even flip it. The deal was too tight. But by doing a novation, we could. But nonetheless, almost nothing has ever made sense to do a burr here in Las Vegas the last year and a half because It's like make 40K on a novation or a flip or a wholesale, or make negative $400 doing a burr. Like, it just has not made sense. But I'm looking forward to it now making sense again here in the next 12 months because I want to start buying rental properties again. And, I'm not expecting it to cash flow like all crazy and go make hundreds of dollars a month. I just want it to break even, and I want to own these assets long term. Like, that's how I'm going to build wealth. I'm going to get the tax write-offs and all the appreciation and the principal pay down and those things. This is also really good news if you are a wholesaler because now you're going to get way more buyers who are looking for rental properties, normal everyday people who are good buying properties 90% of market value versus the flippers who might want it at 80%. So wholesale fees should be going up here this next year in 2025 if you know what you're doing. Prediction number 5, for those who are experienced already doing deals, I believe that virtual deals are going to become far more common now. Back in the day from 2020 to 2023, all we ever did was belly to belly, meaning we would go on in-person appointments to lock up our deals. Now, majority of our deals are virtual. We're closing them right now over the phone. In our CRM, we could write up a contract in less than 60 seconds, get it to the seller while we're talking to them, and get a contract right when they call in. It's crazy. Majority of our deals, like right now, if I were to look at our CRM, 80% of them are being done within the first 48 hours of the lead coming in. Now, part of that is because of a couple of things. One, the lead type allows it. When you have an inbound lead, they're far more motivated than an outbound lead, like a text or a cold call. A text or a cold call, on average, from people that I know who do it a lot of it, it's a 90-day turnaround. Inbound, like I just said, we're locking up a lot of our deals in 48 hours, sometimes same day. And so for me, when I look at that, I'm like, wow, doing these virtual deals for inbound is significantly less work. It's much quicker. It's better on just like almost all fronts. It just costs more and it's a different skill set, right? But I just believe that more virtual deals are going to be or OfferPad or Zillow or these different things. Like, they're used to getting digital offers and now they trust it more versus, man, if you would have did that 10 years ago, sellers would be like, wait, how would you know, like, how do I know you're real? You got to run into that whole objection. Now I think virtual stuff is going to now become far more common, and I think it'll continue to go that way, right? As things like Matterport keep getting bigger, I envision one day when people don't even really have to show houses. I mean, I don't know how far that is. Maybe it's 10 years from now, maybe it's 15 years from now, but I think there's coming a day when everyone has a headset and it's like, yo, you want to tour this home? Like, can you tour it right now? Boom, throw on your headset, tour the home, look at it. Everything's just virtual. It's done right then and there. So, I think that that's coming in the future for all of home buying. But right now, I think we're already seeing it now where sellers and buyers are very comfortable just doing deals virtually. Prediction number 6, raising money is going to get easier. So raising money from 2020 to 2022 was super easy. Probably the easiest ever, right? The government's just printing money. The people giving you money are borrowing it for free, basically, because rates are so low. So it was easy. Everyone's flush with cash, feeling good. Business is going great. Then, rates double and cash is harder to get. People are less likely to lend. The real estate market's going down a little bit. People are fearful of it. All these things are against you. And raising capital is really hard. My friends who have done huge deals, people have raised over $1 billion. They told me, I mean, these are the best capital raisers in the world. They're like, bro, it is 10 times harder to raise money than it was a year ago, 2 years ago, 3 years ago, right? I'm starting to see that shift now, finally. We're starting to see people come off the sidelines, cash coming off. They're like, well, real estate didn't crash. Even through this storm, it still stayed strong. And if rates drop, as we all believe, then they kind of know what's going to happen. Smart money knows. And so it's like, all right, well, time to get our money off the sideline, time to start investing in real estate and making it happen. So I just think that raising capital is going to get significantly easier this year. So if you're somebody who's getting in the game, you're trying to raise money for flips or even a multifamily deal or whatever, it's about to get a lot easier. Now our last prediction, number 7, is very subjective, but I have 100% belief and conviction in it. And it's that you will regret not getting started now. At the end of the day, people are always making excuses, trying to time the market, which is already a stupid thing to begin with. Like, if you're not a pro real estate investor, you haven't done a bunch of deals, what would make you think you could time the market? I mean, that's number 1. But number 2, even if you were to pick arbitrary times of buying real estate in the last 30 years, you'd have won every single time just starting. Now granted, your exit strategy would have had to play a role in starting, but if you were to wholesale at any point during all this, then you would have been fine. If you bought a rental at any part during this, even in 2005, you'd be really fine today. 20 years later, that property is worth way more. You've paid it down, all that stuff. Really the only time you could ever got burned is if you were flipping, right? And, I just alluded to that in 2022. But overall, I could say with pure certainty that if you don't start right now, you will regret it. And this is just period, right? Like, I believe the market's going to be great. I believe that you could do any of the three things I mentioned. You could flip, wholesale, buy rentals. All are a great time to do it. Procrastinate at this point. If you wanted to sit on the sidelines a year ago, or 2 years ago, all right, in hindsight, you could have made the right choice. I wouldn't have said you knew it, especially if you've never done anything before. But it would be hard to argue that you didn't, have good foresight that, hey, flipping a property right now was not a bad idea. And even then, no, I would still say, well, you could have been wholesaling. You could have bought rentals back then. And now when these rates drop, you'll have properties valued years ago that are going to be significantly more valuable today now. And you're going to be able to refinance and have a great rental. So even then, 2 years ago, you should have started. The point is, you should always start. There's really no reason not to start. If you're worried about the market, you want to time it, that is the wrong approach. Just get started today. So anyways, hopefully this video helps you. Let me know which of the predictions are your favorites, and make sure you're subscribed. I'll catch you on the next one. Peace.